Good morning and welcome to this wonderful topic, advanced capital budgeting again. Today we are going to cover very important questions on decision tree and very important questions on real options. So pay attention. All questions I am going to cover today are very important for upcoming exams. So go to question number 55. Question number 55 in front of you. AS Limited has a new wonder product called flute, of which it expects great things. So there is a new product developed by the company and they expect great achievements, great things from this product. At the moment, the company has two courses of action open to it: to test market the product or abandon. That means right now we have two options: test market or abandon the product. If the company test markets, suppose you do test marketing, the cost will be 1 lakh. Cost will be 1 lakh. And the market response could be positive or negative. The market response could be positive or negative. Market response can be positive or negative with probability 0.6 and probability 0.4. If the response is positive, then you have to make a choice. Company can either abandon the product or market it full scale. If the response is positive, you have two choices: go for a full scale marketing or you can abandon. If you read slowly, you will understand. If the response is positive, then this is my D1, this will be my D2, this will be my C1. If the response is positive, company can abandon the product or market it full scale. So again you have to make a decision between the two. If it markets full scale, then what can happen? The outcome may be low, medium or high demand. So there are three possibilities here. The outcome can be low demand, medium demand, high demand with payoff of minus 2 lakh. Payoff will be minus 2 lakh, 2 lakh or 10 lakh, and the probabilities will be 20%, 50% and 30%. If you read and if you simultaneously draw, you will get lot of ideas. So till now you have understood? Any query on this till now? No. Now the next point is, if the response is negative, suppose the response is negative, we are here, response is negative and the company goes ahead and markets the product, the net loss is estimated at rupees 6 lakh. If the company goes ahead and markets the product, then the net loss will be 6 lakh. If at any point the company abandons the product, there would be a net gain of 50,000 from the sale of the scrap. So you have two choices here. One is you can go for marketing, you will incur 6 lakh loss. Second option is you can abandon. If the response is negative, you can abandon. At any stage if you abandon, you will get 50,000 rupees. At any stage if you abandon, you will get 50,000 rupees. Look at the diagram again. I'll explain and we'll draw it together nicely later. You are here D1, test market or abandon. Test market will cost you 1 lakh. Response can be positive, negative. Positive response 6.6 probability, negative response 0.4 probability. If it is positive, you have to make a choice between full scale and abandon. If you abandon, you get 50,000. If you do full scale marketing, there are three outcomes possible: low, medium, high demand, 0.2, 0.5, 0.3, and these are the payoff: minus 2 lakh, 2 lakh and 10 lakh. If the response is negative, you can still go for selling the product, you will suffer 6 lakh loss, and if you abandon the product, you will get 50,000 rupees. So that is the decision tree, and you will have to move backward and arrive at the answer. Now it says all financial values have been discounted to the present level. No need to compute discounting. No need to do discounting because all figures are already in the present value terms. Required: draw a decision tree, evaluate each option and suggest an action plan. So first we will draw the decision tree. Very good question. First you mark it very good question, important for the exam. Write down important for the exam. This kind of questions are asked in the exam on decision tree. Step number 1, draw the decision tree. Start with a decision node. Start with a decision node. Draw a little bigger diagram. Bigger diagram because you will have to write something inside the box also. So at least you should have space to write one more number below that. We'll come to this. What are the two choices we have here? Today we have two choices: test market the product, question in front of you, or abandon the product. Test market or abandon the product. If you abandon, you will get 50,000. 50,000, we have written rupees in thousand in the diagram, and if you test market, the cost of test marketing is 1 lakh, that is 100,000. If you test market, there will be consequence, there will be outcome. The outcome can be positive. If you do the test marketing, you find that people are very positive about it, or you may find that people may have negative opinion about it. Okay, so negative 0.4, positive 0.6, these are the probabilities. If you get positive outcome, then again you have a choice. What are the two choices we have? One is to go for full scale marketing. Keep writing along with me. And second option is to abandon the product. Are you writing? Are you writing? Yes or no? Later on we will not have time, so simultaneously write. So full scale marketing, if you abandon, you will get 50. If you do full scale marketing, there will be outcome. What are the three outcomes possible? The three outcomes possible are low demand, medium demand, high demand, whose probabilities are 0.2, 0.5, 0.3. 0.2, 0.5, 0.3, and the payoff will be minus 200, plus 200, plus 1000. All rupees are in thousand. And now we'll come to this point. This is still open. If you get negative feedback from test marketing, again we have two choices. One is to abandon and one is to go for full scale marketing. If you go for full scale marketing, loss will be 6 lakh, 600 in 1000. And if we abandon the product, we will get 50,000. We will get 50,000, right? This is the decision tree. Any query on this decision tree? Please ask me right now. Any query on the decision tree? No queries? How do we do evaluation? Evaluation will be done from right to left. The rightmost circle is C2. So first we'll find value of C2. Write down below step 2, evaluation. Under that write down 1, expected value at C2. Expected value at C2 will be equal to 0.2 into minus 200 plus 0.5 into 200. Please give me the answer. Keep your answer ready. 0.3 into 1000. What is the answer, please? Anybody who can give me the answer? If you give me the answer today, God will give you answer in the exam. So what is the answer here? Is it 360? 360 is right. You can put 360 in the circle also here. Can you see I have written 360 here? That means the value of C2 is 360. Put the values in that circle 360. Now C2 is emerging from D2 and D2 has two branches. What is the objective? The objective is maximization of profit. So I will take higher of the two figure. Now write down expected value at D2. It will be higher of, if we go for full scale, the value is 360. If we abandon, we'll get 50. So whether you will go for 360 or whether you will go for 50, what is the answer? Which one you want? 360? 360 is right. Which means if my result is positive, I'll go for full scale marketing. So option to abandon we will cancel here. That option will not use. Now write down expected value at D3. Expected value, you can put the number here also for easy calculation. Next step, 360 you put here by showing the calculation. Expected value at D3, higher of, it's a decision box, higher of minus 600 or 50. So 50 is higher. 50 is higher means the value of D3 is 50. Cancel the full scale. Cancel the full scale. That option will not exercise. If I get negative result, I will abandon the project. Now these two branches are emerging from C1. So now next question will be expected value at C1. Expected value at C1 will be expected value 0.6 into 360 plus 0.4 into 50. Anybody who would participate in discussion and reply? Some of you have joined as a viewer. Answer please. 236. The answer is 236. Expected value of C1 is 236. Expected value of C1 is 236. Very good. And the last step, what is the last step? Expected value at D1. expected value at D1 will be, D1 is a decision box, so I have to choose higher of the two, higher of. If I go for test marketing, payoff is 236, but there is a cost 100 also, so 236 minus 100, and if I abandon, I'll get 50. So what is the answer? The answer is 136. The answer is 136. First you have to draw the decision tree very nicely. So we are going to cancel abandon option. So my decision would be, first you do test marketing. If the result is positive, go for full scale. But if the result is negative, abandon the project. Today we'll go for test marketing. If the result is positive, go for full scale marketing. If the result is negative, abandon the project. That is how we'll take decision at the 3 decision point. At D1 test market, at D2 full scale, at D3 abandon the project. I hope this is right. So let us write the conclusion. Write the conclusion, decision write down. You have to end the decision tree with a decision, with an answer, with a conclusion. So please write down, test market the product. Test market the product. Test market the product. If the outcome is positive, market full scale. If the outcome is positive, market full scale. If the outcome is negative, then abandon the product. If the outcome is negative, then abandon the product. If the outcome is negative, then abandon the product. If the outcome is negative, abandon the product. That was this very important question number 55. Any query? Students are requested to ask queries. Yes, any query? Yes or no? Just tell me yes or no. Then accordingly I will go to the next question. No query, question number 56, taken from your study material. All study material questions are important, because that is the main source of question bank for the institute. 56 number important, and the answer is also there, but we are going to solve in the notebook. We are going to solve in the notebook. Question number 56. L&R Limited wishes to develop new virus cleaner software. Very good. The cost of the pilot project is 2,40,000. So in case if you want to, like the previous question, do the pilot testing, that is called testing. Pilot means pilot testing, whether it will cost you 2,40,000. Presently the chances of the product being successfully launched on a commercial scale are 50%. So if the project is successful, whose probability is 50%, then it can be commercially launched. In case it does succeed, L&R can invest a sum of 20 lakhs to market the product. So suppose I start from here. One option is to do test. Second option is here, do not test. If you test, here will be outcome. You will get success with 0.5 probability, or you may get failure with 0.5 probability. If you get success, then again you have to make a decision. What is the decision you have to make? You have to invest 20 lakh. You have to invest 20 lakh, or the second option is not to invest 20 lakh. If you invest 20 lakh, such an effort can generate perpetually an annual net after tax cash flow of 4 lakh. So you'll get 4 lakh per annum perpetually. For that you have to compute the present value, because 4 lakh per annum forever means there is a present value calculation requirement. If the commercial launch fails, they can make an investment of a smaller amount of 12 lakh. Suppose it fails, then again you have to make a choice: invest, do not invest. If you invest, you will require 12 lakh. You can see the diagram in your book also. You can see the diagram in your book also. If it is not visible on the screen, with the hope of gaining a perpetually a sum of 1 lakh. If you invest 12 lakh, 1 lakh per annum perpetually you will receive. 1 lakh per annum perpetually you will receive. Evaluate the proposal adopting decision tree approach. The discount rate is 10%. The discount rate is 10%. Is it right? So first what we'll do, first we'll understand the question again. Very important question we are discussing from your study material. You have two options today: test, do not test. If you do not test, matter closes there. If you go for testing, which will cost you 2,40,000, there are two outcomes possible: success and failure. If it is successful, you have to make a choice: invest 20 lakh, do not invest. If you invest 20 lakh, cash inflow generated will be 4 lakh per annum. And if you do not invest, nothing, you will not get anything. The second is, if you fail, you have to invest 12 lakh rupees, option 1, which will generate 1 lakh per annum perpetually, or the second option is below, do not invest. So what we'll do, we'll first draw the diagram, evaluate from right to left. The objective is maximization of gain. The objective is maximization of gain. So whenever there is a decision point, we are going to take higher of the two. Is it right? So draw the diagram first. I request all of you to draw the diagram first in the notebook. When you do yourself, you will learn more. Just don't read the answer. So first start with point number A. They have written A, B, C, D. No problem. A represents option 1, test market. You will incur 2,40,000. You will incur 2,40,000. And second option you have, second alternative you have, no test. Don't do anything. If you don't do anything, you will not get anything. That is how system works, whether it is product or whether it is exam. If you do something, you will get something. If you do nothing, you will get nothing. Now, if you do test marketing, there are two outcomes possible: success and failure. 0.5, 0.5. If you get success, again there is a decision box here, square. A square or a rectangle you will draw. Invest 4 lakh perpetually. Invest 4 lakh invest 20 lakh. Income is 4 lakh perpetually. Income is 4 lakh perpetually per annum. The second choice is do not invest. If suppose the test market is a failure, still we have to make a decision whether to invest 12 lakh or not to invest. If you invest 12 lakh, your income is 1 lakh perpetually, and if you do not invest, you will not get anything. This is how you will interpret the question. Now what I am going to do now, we are going to evaluate C, we are going to evaluate D by taking higher of the two. B is a chance node. Consequence, so here we will apply expected value formula. 0.5 into the value of C plus 0.5 into value of D. Again A is a decision box, will take higher of the two. Whatever is the value of B you will get minus 2,40,000, and no test means zero value. So higher of the two we are going to take, and with that this answer can be done. So please write down step 2 evaluation. Step 2 evaluation, expected value of C. Expected value of C is equal to higher of, now I'll explain again, I'll go to the previous diagram. We are here, we are at this point, we have to make a choice between to invest or not to invest. If I invest, I'll get 4 lakh per annum perpetually. The present value of perpetuity is equal to annuity upon R. Annuity upon R. Annuity here is 4 lakh. So 4 lakh divided by 10% will be my income, minus 20 lakh is my investment. So my profit will be 4 lakh divided by 10%, 40 lakh minus 20 lakh. 20 lakh is the net payoff, net positive profit you can say, if I invest. If I do not invest, I'll get zero. Which is higher? Investment is higher or do not invest is higher? So first you simplify 20 versus 0. If you invest, payoff will be 20 lakh. If you do not invest, payoff will be 0. So the answer is 20. The expected value of C is 20. And in the same way, we will compute expected value of decision node D, higher of, in bracket, again in bracket, 1 divided by 10%. 1 divided by 10% is the PV of perpetuity, minus 12. 12 is the investment, comma, if you do not invest, you will get 0. If you do not invest, you will get 0. So how much is the answer? 1 divided by 0.10 means 10, minus 12, minus 2 versus 0, minus 2 versus 0. Which is the higher number, minus 2 or 0? Please reply. Let me check your intelligence. 0 is higher. Very good. Now write down expected value of B. Expected value of B. B is a chance node. So you have to multiply the probabilities into values. If you look at it, I'll just go behind to explain again. We are here. The value of C is 20. You can write the value of D is 0. So value of B will be 20 into 0.5 plus 0 into 0.5. Write down. Value of B will be 20 into 0.5 plus 0 into 0.5, which comes to 10. Value of B is 10. B is originating from A. A is a decision node. A is a decision node. So I will take higher of. I will take higher of in bracket 10 minus 2.40, because if I do test marketing, then I have to incur 2.40. If I don't do anything, my cost is 0, revenue is 0. So the answer is 7.60, comma 0. Which is higher, 7.60 or 0? 7.60 is higher. 7.60 is higher. So what will be my conclusion? Conclusion will be, in the beginning you have to do test marketing. If the test is successful, invest 20 lakh. But if the test is a failure, then do not invest. If the test is a failure, then do not invest. Is it right? So I'll just go to the previous diagram. In the previous diagram, this option you will cancel, not to invest in the first one. This option you will cancel and no test option you will cancel. So what is left? Test market. If successful, invest 20 lakh. If failure, do not invest. So that is how the decision tree is prepared, evaluated, and the decision is to be written. So write down decision. Write down decision. Nicely write down. One day you have to appear in the exam. Same question will appear in the exam. Decision: invest a sum of rupees 2,40,000. Invest a sum of rupees 2,40,000 and undertake the test. Invest a sum of rupees 2,40,000 and undertake the test. Next line, if outcome is success, invest rupees 20 lakh. If outcome is failure, do not invest. If outcome is failure, do not invest. You have to write answer for all the decision boxes. There are 3 decision boxes, A, C and D. At A, you will invest 2,40,000 and do test marketing. At C, you are going to invest 20 lakh. At D, you are not going to invest. If you write the answer like this in detail, you will get full marks. Okay. Question number. Welcome to 57. Again write down. Very important question. It was asked in RTP November 2010, and before that I think it was asked in 2002 also, long back. Okay, same question is appearing in RTP and it will appear in your exam. So please mark it very important. Later on, don't tell me I have not informed you. Is it right? My duty is to inform you which questions are important. Of course, all questions are important, but some are more important. Like politicians, all human beings are equal, politicians are more equal. Right? Do you agree with that? Those who agree will say yes. AS Foundation, a small publisher, is publishing economy edition of a new book on financial management. Wow! Question is very appropriately drafted. The cost of typesetting and other related cost will be 1 lakh. The cost of printing per book will be 20 rupees. Okay, don't think the book that you are getting is 20 rupees. Nowadays it costs a lot. Then if additional books are needed at a later time, the setup cost will be 50,000 per setup. Setup cost means in order to start printing, you have to do some setup. You have to make some plates, some font setting, and then there are certain processes which are done. Nowadays it is done on the computers directly, so this issue is not there. But the question is, as I said, old question, and that time the printing used to require typesetting and certain other related cost to begin printing, and which was a one-time fixed cost. Once you incur it, you can print as many copies as you want. Printing cost is variable per book because it will require paper, glue, binding, that is 20 rupees. Suppose you want to print again. Then you have to incur setup cost again. But second time the setup cost will be 50,000 because lot of work is already done in the first time. So second time if you do setup, if you want to print again, then 50,000 rupees will be the cost. However, cost of printing the book shall remain the same. Means printing cost will be 20 rupees. selling price of the book is 140 rupees per copy. Royalty to author, commission of agent and other related delivery charges will be 40 rupees per book. So in short, your net amount realized at the time of sale will be 100 rupees. Net amount realized on sale will be 100 rupees. 140 selling price, royalty to author, commission of agent and other delivery charges 40, so 100 rupees, and 20 rupees is your printing cost. Printing cost will be incurred at the beginning. Sales takes place at the end. So I am not deducting 100 minus 20 because in this question there is a present value calculation involved. So the timing of occurrence of cash flow is also important. Is it right? The future sale of book depends upon the review of the book. The future sale depends upon review of the book. Of course, in book business, review is very important. If the review is good, then people buy your book in large quantity. If review is bad, oh my God, nobody buys. In case the book gets good review, it is expected that the sale of book will be 5,000 copies per year for 3 years. So 5,000 into 3, 15,000. On the other hand, if it gets bad review, oh my God, the sale will be only 22,000 in the first year. Only year 1 will be 2,000 and then the sale will cease. Year 2 0, year 3 0, because once the book gets the bad review, nobody is going to buy. Probability of good review is 0.3 and probability of bad review is 0.7. Mr. X, owner of the publishing house, faces a choice between ordering an immediate production of 15,000 copies. So you have two options in this question. One is to print 15,000 copies. The second option is to print 5,000 copies today. To print 5,000 copies today. Because you don't know what will happen. Followed by, if you print 5,000 copies, but suppose the review is positive, you will have to print additional 10,000 copies. Followed by an additional production run at the end of first year if the book is successful. If you print 15K, two outcome will be there. One will be good review and one will be bad review. If good review will be there, probability is 0.3, bad review 0.7, and in case of good review you will be able to sell 15,000 copies. But if it is bad review, you will be able to sell only 2,000 copies. So here we will be able to sell 5,000 copies per annum for 3 years. But here we will be able to sell only 2,000 copies in year 1. Only 2,000 copies in year 1. If you print 5,000 copies, then there are two outcomes. First is good review, second is bad review. If you get good review, you have to make a choice. What is the choice? You have to print additional 10,000 copies or do not print additional 10,000 copies. We have a choice. After getting good review, we can print additional 10,000 copies or do not go for additional printing. And if it is bad review, of course you are not going to print additional copies. So this is my decision tree. I am going to further explain in the diagram, because here we don't have space, so the presentation is not good. You will not understand much. So I am going to explain the same thing in the proper diagram. Question is, using decision tree analysis, recommend production schedule and decide whether the book should be published or not. Decide whether the book should be published or not. Is it right? So I'll first draw the decision tree for you. Write down in the notebook. If you look at the answer given to you by the institute, they forgot to draw the decision tree only, and they are writing the question using decision tree analysis, and in the answer there is no decision tree. This way the institute will trouble you. So we have two options here: print 15,000 copies, print 5,000 copies, and maybe you can draw one more line, that is do not print. Do not print also is an option. If you do not print, nothing will happen. Zero value. At least 0 is better than negative figure. In case these two options are generating negative answer, then I will go to the third option, do not print only. If print 15,000 or print 5,000 copies give me negative answer, then I will go to do not print option. Okay. If you print 15,000 copies, you will get good review whose probability is 0.3, and you will get bad review whose probability is 0.7. What about the value? Expected value. The expected value calculation I will do in working note 1 and I will do in working note 2. Sir, why? Because it will require a lot of calculation. It will require calculation of investment, present value of cash flow, then profit. Lot of calculation gets involved. Therefore, it is better to prepare a working note. If I write here so many things, the diagram will become very messy. Okay. Now write down bad review 0.7 is the probability, and the monetary value will prepare working note 2. If you print 5,000 copies, again there are two possibilities. You will get good review, probability is 0.3, or you may get bad review, probability is 0.3. 0.7. Probability is 0.7, right? But if you get good review, again you have to make a decision whether to go for additional setup of 10,000 more books, because I have printed only 5,000 copies, which means market will absorb 15,000 copies. So should I print another 10,000 copies or no? All this depends on numbers. Ultimately, I must make profit. So what will be my monetary value? I will prepare a working note 3 for that, because it will require incurring setup cost 2 times, one in year 0, one at the end of year 1 also. So all this calculation I have to consider, and because the time value of money is given, my calculation has to take care of the timing of occurrence of cash flow. And I have another choice also, no additional setup, non-additional setup. Don't do anything, be happy with whatever you got. Okay. Working note 4. And the last is, if I print 5,000 copies and if I get bad review, I print 5,000 copies, I get bad review, what should I do? I will calculate the net profit, working note 5. So this question will require 5 working notes. okay, for W1, W2, W3, W4, W5. Not only that, then I have to find C1 also, C2 also, and D1 also. So total 8 working notes I will require. 5 working notes to find out the expected monetary value, which I have written WN1, WN2, WN3, WN4, WN5, but then I have to move backward also, reach C1, reach C2 and reach D1. Okay, are you ready for this question? Write down working note 1. See, I am going to prepare working note 1, which means I will print 15,000 copies and will get good review. What will be my present value of net cash flow? What will be my present value of net cash flow? Write down working note 1. Question should be in front of you. Calculation of NPV. Under that, in bracket write print 15,000 copies. Decision is to print 15,000 copies and good review. And good review. Print 15,000 copies and good review. So that will tell you where are we. So under that you write down in year 0, point number A, year 0 cash flows. Year 0 cash flows. Today what cost I will incur? Today I will incur initial setup cost, which is a fixed amount 1 lakh. Initial setup cost will be incurred once only if I print entire 15,000 copies today. This is how the printing business work. More you print in quantity, your cost goes down. Second is printing cost. Printing cost will be 15,000 copies into 20 rupees. 15,000 copies into 20, that you have to incur today. Before selling the book, print the books. So that comes to 3 lakh. So write down total 4 lakh. So 4 lakh is my investment. 4 lakh is my investment. Then write down cash flow in year 1-3 year. Because I will print in one lot and review is good, I will be able to sell 5,000 copies each year. So now write down selling price per copy. Selling price per copy 140 rupees. Royalty, commission and other charges. Royalty, commission and other charges 40. You are writing a CA exam, a professional exam. Answer should be professionally drafted. Realization per copy. So what is your net cash inflow or contribution per copy? 100 rupees. Number of copies sold per year. Number of copies sold per year. Number of copies sold per year 5,000. Total cash inflow per annum. Total cash inflow per annum. Total cash inflow per annum 100 into 5,000, 5 lakh. 5 lakh is per annum for 3 years. Now write down PV annuity factor. PV annuity factor presentation is also important. All calculations must be presented. 10%. Is it 10%? Yes, 10% and 3 year. Anybody who would like to reply 10% and 3 year annuity factor is how much? 10% comma 3 year. How much is the annuity factor? 2.487. Please check. Please check 2.487. Is it right? 1 divided by 1.10 equal to 3 times equal to GT. 2.486 is right. 2.487. You are right. Therefore, PV of cash inflow. Therefore, PV of cash inflow is multiply point number 5 into point number 6. B5 into B6. Just please confirm whether it is 12 lakh 43 500. 1243,500 is right. Yes. What is your investment? 4 lakh. What is your PV of cash inflow? 1243,500. So are we getting positive NPV? Point number C. NPV will be equal to B7 minus A3. B7 minus A3. The answer is 843,500. What more do you want me to write? Do you think I have missed anything, including comma, full stop? So we have written everything. Even the institute has not presented that well. You can see below, their answer is 843,500, but difficult to interpret their answer because they have directly written numbers. Now we'll go to working note 2. Calculation of NPV. Print 15,000 copies. Print 15,000 copies. So we'll print 15,000 copies, but we get bad review. So what is the problem? You'll be able to sell books only in first year, and that too only 2,000 copies. But your initial setup and printing cost will be incurred. So write down point number 8, total cash outflow 4 lakh as per working note 1. So we are not writing 1 lakh, 3 lakh plus equal to 4 lakh again. And then write down total cash inflow in year 1. Only your first year sale will be there, that too 2,000 copies. So this is a very good question to understand the printing of books business. Realization per copy is 100 rupees. Number of copies sold will be only 2,000. If your review is bad, then you can only sell 2,000 copies. Total cash inflow will be B1 into B2. Total cash inflow will be B1 into B2. Only 2 lakhs. So sad. PV factor for 1 year and 10%. PV factor is 1 year and 10%. That is, all of you know, 0.90909. PV factor is 0.90909, and therefore PV of cash flow will be 2 lakh into 0.90909, and that is equal to 181,818. 181,818. NPV will be equal to, this is my inflow, this is outflow. NPV will be equal to B5 minus A. B5 minus A, negative answer, 2,18,182. 2,18,182. Is it right? 2,18,182. Please confirm if it is right. 2,18,182 is right. Okay. So we'll go to the next working note 3. Now go to the second option, print 5,000 copies. When you print 5,000 copies, you can get good review. And if you get good review, then there are two choices: additional setup, non-additional setup. So we are going to first print 5,000 copies. If we get good review, we'll go for additional setup. What will be the NPV? And then we'll also calculate print 5,000 copies, good review, but no additional setup. So two working note I am going to prepare right now for 5,000 copies, good review. Under good review also we have two options: additional setup, no additional setup. Working note 3, calculation of NPV. I hope you are able to understand where we are. 5,000 copies, good review, additional setup. Initial setup cost in year 0. Diagram should be in front of you continuously. First I am going to incur 1 lakh rupees for printing 5,000 books, initial setup cost, and my printing cost in year 0, printing cost of 5,000 books in year 0. First I am going to print 5,000 books only. I don't want to take risk. It is 1 lakh. Point number C, total outflow in year 0. Total outflow in year 0 will be 2 lakh. So in year 0, I will incur 2 lakh rupees and I will print 5,000 copies. Net cash inflow in year 1. Now let us see cash inflow in year 1. Net cash inflow in year 1. In first year what we'll do? We will sell 5,000 copies because review is good. We'll sell 5,000 copies. Contribution, point number 1, contribution. Point number 1, contribution. Contribution is equal to 5,000 copies. We are going to sell 5,000 copies in the first year, and contribution will be 140 rupees selling price, 40 rupees other cost, 5 lakh. Point number 2, additional setup cost. But then I find that the review is good. I may decide to do additional setup cost. Additional setup cost will cost me 50,000. Every time I will do additional setup, it will cost me a fixed amount of 50,000. And I am going to print 10,000 books now. Do you want to print 5,000 books or 10,000 books? If you print 5,000 books, next year again you have to incur additional setup cost. Okay, so it is better to incur one time setup cost of 50,000 and print 10,000 books, which will be sold in year 2 and year 3. So add printing cost. How many books do I need to print now? 5,000 I have already printed here. So now I am going to print 15,000 minus 5,000, 10,000 books at rupees 20 each. So that is 2 lakh. So my net cash inflow in year 1, you add these three numbers, D1 plus D2 plus D3, and that is equal to 2,50,000. So year 1 cash inflow will be 2,50,000. Now write down cash flow of year 2 and 3. Cash flow of year 2 and 3. Cash flow of year 2 and 3. Year 2 and 3 will be simply, you are going to sell 5,000 copies, 100 rupees contribution. 5,000 into 100, that is 5 lakh. So my cash flow is, understand, year 1 2,50,000, year 2, year 3 5 lakh each. Year 1 2,50,000, 2 5 lakh, 3 5 lakh. So can we compute the present value of this now? Can we compute the present value of this now? Yes. So write down point number F, PV of cash inflow. PV of cash inflow, 2,50,000 you will receive in year 1, divide by 1.10. 5 lakh you will receive in year 2, divide by 1.10 to the power 2. 5 lakh you will receive in year 3, divide by 1.10 to the power 3. Can you please solve it and write in the outer column? Can you please solve? Please solve. Give me the answer. Give me the answer. Let us see who will answer first. Check the answer now. 10,16,153. 10,16,153. Is the answer right? 10,16,153. Please confirm if the answer is right. If the answer is right, please confirm, because accordingly I have to move ahead. Is the answer right? $10,16,153. Okay. So what is your NPV now? 10,16,153 minus 2 lakh. So write down NPV F minus C. F minus C 8,16,153. 8,16,153. So this is my answer for working note 3. One assumption we have made in this working note, that we are going to print 10,000 books in year 1. You can print 5,000 also. Again next year you can print 5,000 also. So whatever assumption you are making, write a note for that. Note write down in the above answer. Note write down in the above answer. It has been assumed that to avoid again setup cost, in the beginning of the second year 10,000 copies will be printed. It has been assumed that to avoid again setup cost, in the beginning of the second year 10,000 copies will be printed in the end of the first year. 10,000 copies will be printed at the end of the first year. 10,000 copies will be printed at the end of the first year. Okay, so we will incur setup cost only once and print 10,000 copies. If you print 5,000 separately, setup cost will be incurred one more time. That is the note, which is very much understandable. Now we'll write down working note 4. Working note 4 is calculation of NPV. Print 5,000 copies, good review, non-additional setup. You don't want to print further, you are happy with 5,000 copies only. So in that case, my NPV will be, I am going to sell 5,000 copies, I'll make a contribution of 100 rupees per copy. 5,000 into 100 will be my contribution or cash inflow in year 1. Divide by 1.10 will give me present value of cash inflow minus initial cost 2 lakh, which is calculated in the previous working note. This 2 lakh is as per working note 3 if you want to write. So the answer would be 254,545. 254,545. That is my answer if I do not print further, even though I get good review. Even though I get good review, I do not print further. And what is my working note 5? Calculation of NPV. If I print 5,000 copies first and get bad review, if I get 5,000 copies and get bad review, I will be able to sell only 2,000 copies and my contribution will be 2,000 into 100 received at the end of year 1. So NPV will be equal to 2,000 into 100 divided by 1.10 minus 2 lakh. Question in front of you. If you keep question and the diagram in front of you, you will understand easily. Okay. So what is the answer now? What is the answer? It is negative 18182. 18182 negative. The answer is not over. Now we have to do backward calculation. We have to move to C1, then C2, okay, then D1. So point number, write down next, working note 6. Working note 6. Expected NPV at C1. Expected NPV at C1. Expected NPV at C1. It is a chance node. There are two branches, good review, bad review. Good review, if you get good review, your NPV is 843,500 with probability 0.3. If you get bad review, you can check in your working note 1, 2, 3, 4, 5. You will get 218, 182 with 0.7 probability. So can you please solve it? Solve it. Solve it. What is the answer? 1,322,000. Just check the answer and confirm. 1,322,000 is right. Now write down expected NPV at D2. Expected NPV at D2. Expected NPV at D2. D2 is a decision box. You have to go for additional setup or no additional setup. I will take higher of the two. I will take higher of the two. I will take higher of the two. You refer your working note 3 and working note 4. Refer working note 3 and working note 4. Refer working note 3 and working note 4. You have 816, 153, 254, 545. So I will go with 816, 153, which is I will go for additional setup. Now one more, working note 8. Expected NPV at C2. C2 has got two branches, good review, bad review. For good review, you will take the previous answer 816, 153. And for bad review, you will write the working note 5 answer. So expected NPV at C2 will be 0.3 into value of D2 816,153 plus 0.7 into bad review. Answer for bad review 18182 negative. So we'll simplify this and just confirm the answer, please. Is the answer 232,119? Is the answer 232,119? Is the answer 232,119? Yes. Now we'll go to last part. Wonderful question. Expected NPV at D1. Expected NPV at D1. Expected NPV at D1 is higher of, it is a decision box. You can see there are two branches, print 15,000 copies, print 5,000 copies, and one is 0 also, but that 0 you ignore. So if I print 15,000 copies, I will get 1,322,000. If I print 5,000 copies, I will get 232,119. 232,119. So what is better? 232,119 is better. 232,119 is better. Is right, 232,119. So finally, what is my decision? Should we print 15,000 copies or 5,000 copies today? The answer is we should print 5,000 copies today. We should print 5,000 copies today, and on getting good review, go for additional setup. And on getting good review, go for additional setup. and on getting good review, go for additional setup. Assumption I have already dictated to you. So that was a very, very important question, and if it is asked in the exam, if you are well prepared, you can do it. Otherwise, you will struggle in the exam to visualize all these calculations. So please today, as a homework, practice on your own. Do not read the answer. In spite of the teacher telling you 10 times every day that you have to work hard, you are in your own zone only. You think by reading the answer I will be able to succeed. Okay, sorry boss, that will not happen. Okay, we'll go to one self practice question, number 97. 97 number question. Can you believe that in one book at one place you have 97 questions? 97 number question is from RTP November 2008, and similar questions have been asked in the earlier exams also. Ready for question number 97. Although it is printed in the book, but students get confused, so I thought I will take it. AS Foundation is wondering whether to drill for oil in Chamesfield Basin. Wow, the prospectus are as follows. Now this is a very good question on understanding oil business. To get oil you have to drill, and you don't know when will you get oil, so you first dig 2000 feet. First you will dig 2000 feet. Okay, so we have to make a decision. Decision is to drill and do not drill only. First we'll drill 2000 feet. If we drill 2000 feet, there are two possibilities. One is you will find oil. Suppose you find oil. If you find oil, matter closes there. If you do not find oil, then again you have to take a decision, because then you can drill another 2000 feet. So what are the two decisions we'll have to take? Drill another 2000 feet, and the second option is do not drill further. Lose the hope, do not drill further. If you drill another 2000 feet, again you have two possibilities. You may find oil, no oil. If you find oil, the matter ends there. If you do not find oil, again you have to take a decision to dig another 2000 feet. To dig another 2000 feet. This is a very good question. And do not dig. So suppose you work in some oil exploration company like Reliance, okay, NTCP, NTPC, etc., then you will require this analysis. And if you dig 2000 feet, again there are two possibilities. You may find oil, no oil. Is it right? And they have given you probabilities also, 0.5, 0.5, then 0.2, 0.8, 0.25, 0.75. So that was drawing the diagram, and then you have to put the values also. How do we put the values? If you drill 2000 feet and if you find oil, drill 2000 feet and find oil, then your drilling cost is 4 and the PV of oil is 10, which means you will make a profit of 6 here. And this way we will do it. I will solve in the diagram and explain. Okay, this way we will do it. We don't have enough space to write now, but you have got the idea. These are the cost you are incurring and these are the PV of oil. one correction in some books required. You will find 5 is printed in few books. The first lot got 5. Make it 6 now. Because if you dig more, you will incur more cost. For digging 2000 depth, 4 million. For 4000, 5 million. And for 6000, you will incur 6 million. And the PV of the oil is given here. So we don't have to do PV calculation in this question. All PV calculations have already been done for you. Draw a decision tree showing the successive drilling decision to be made by AS Foundation. So how many decision points are there? First is today, should we drill 2000 feet? Second, if I don't get oil in first 2000 feet, should we drill another 2000 feet? If the answer is if I don't get oil, again the next decision point is should we drill further 2000 feet? The answer all depends on number crunching. Okay, at decision point I will take higher of the two, and at chance point, there are 3 chance point also, I will take expected value. At decision point we will take higher of the two, at chance node we will take expected value. So let us write down decision tree. Let us write down decision tree. Please draw along with me. First D1, start from D1. You can take the help of your book also. D1, today, drill up to 2000 feet. And the second option is do not drill. Matter closed if you do not drill. If you drill 2000 feet, then there are 2 possibilities. You may find oil, or you may not find oil. That means the well remains dry. You can write dry, you can write do not find oil. And the probabilities are 0.5 and 0.5. Now see the calculation. If you find oil, see the calculation, and you will also write your PV of oil is 10 minus 4 is your cost of drilling. So net PV would be 6 million. Net PV would be 6 million. Is the first part understandable? Is the first part understandable? Then suppose I do not get oil, the well is still dry, I will have to make a decision. Should I drill up to 4000 feet? That means drill 2000 feet more, or do not drill, Now if I do not drill, my diagram will not move further, but if I drill further, then there are 2 possibilities. And if I do not drill, whatever cost I have incurred is my loss. So I will drill 2000 feet. I find that the well is dry and I have decided not to drill further. Whatever cost I incurred will be my loss. Minus 4 million. Minus 4 million, write down. Minus 4 million. But if I decide to drill further, again there are 2 consequences. Consequences, you may find oil whose probability is 0.2. You may find the well is dry whose probability is 0.8. Just keep the question in front of you. Have patience, you will understand. If you find oil, what is your NPV? Last column, PV of oil is 9. PV of oil is 9 and your total cost incurred till date is 5. So therefore, you will get 4 million NPV. You will get 4 million NPV, and suppose you find that the well is dry, you are here, You have two choices here. One is drill further 2000 feet or drill up to 2000 feet, and the second choice is do not drill. Now tell me, if you do not drill further, what is your total loss till now? You have drilled up to 4000 feet and you have not got what oil. What is your loss? What is your loss? Come on, what is your loss? Your loss is 5 million, because you have incurred 5 million in drilling and still you have not got the oil. So your loss will be 5 million. Now the next part is, suppose I drill up to 6000 feet. Now again there are two possibilities. Find oil, probability 0.50, and what is your NPV if you find oil? Last column, PV of oil is 8, total cost incurred till now, till drilling 6000 feet is 6. So my NPV would be 2 million. My NPV will be 2 million. And my bad luck, I do not get oil even after digging 6000. What is my total loss? Yes, anybody? What is my total loss if I dig 6000 feet and I don't get oil? What is my loss? Come on. What is my loss? The total cost that you incurred in drilling 6000 feet, that is 6 million. 6 million would be your loss. Is it right? So first you read the diagram, read the question, convince yourself that I have understood. Then I'll move further. Have you understood? Yes, have you understood? Please reply. Have you understood? Yes, very good. So now the question is very easy. I'll explain what I'm going to do below that. I'll value C3 first, then D3, then C2, then D2, then C1, and then D1. So total I will require 6 working notes below. Write down below. Step 2, evaluation. Presentation is also a skill and you have to do it very nicely. So students are requested to write properly. Step 1, expected value at C3. Always start from the rightmost circle or decision node. So you will find there the probabilities you have written 0.25 into 2 plus 0.75 into minus 6. Can you please give me the answer? What is the answer? This is minus 4. Oh. Step 2, expected value at D3. Expected value at D3. D3 is a decision node. I will try to maximize my return. So higher of minus 4 we have got in the step 1, and minus 5 is the loss. So what is your answer? Minus 4 is higher or minus 5 is higher? Which is the bigger number? Today I will test your mathematics. Minus 4 is a higher number. Very good. Now next is, go to C2 now. Expected value at C2. Expected value at C2, 0.2 into 4. Question in front of you, diagram in front of you. And plus 0.8 into minus 4. Plus 0.8 into minus 4. This is minus 2.4. This is minus 2.4. Very good. Come on, next. Step number 4. Expected value of D2. Expected value of D2. Expected value of D2 is higher of minus 2.4 comma minus 4. Which is higher? Minus 2.4 is higher or minus 4 is higher? Some student will say minus 4 is higher, sir. 4 is bigger than 2.4. What you are teaching? Minus 2.4 is bigger number when it comes to negative number. Now write down step 5. Expected value at C1. Expected value at C1. This is a chance node. Probability is 0.5 and 0.5. So multiply 0.5 into 6 plus 0.5 into minus 2.4. Yes, what is the answer? Anybody who would like to reply? 1.8. 1.8. And now one last step which you will solve and tell me the answer. Step 6 you will solve and give me the answer. Expected value at D1. Expected value at D1. Anybody who got the answer? 1.8. Very good. Higher of 1.8 or 0? 1.8. This way you have to present your answer nicely. Okay. This is our way of presentation. Institute has prepared table for every calculation. That is also okay. Either way, you must get the right answer. That is my objective. Any query on this question? So you will conclude your answer by writing the decision. The decision is first drill up to 2000 feet. This 1.80 is the value of drill up to 2000 feet. If oil is not found, then drill up to 4000 feet. If oil is not found, then drill up to 4000 feet. Again write down full stop. If oil is not found at 4000 feet, then drill up to 6000 feet. Then drill up to 6000 feet. Then drill up to 6000 feet. This is my decision for this question, and mark this question and the previous question very, very important. Okay, don't be surprised if it is asked in the upcoming exam or your exam. So that completes some of the important questions on decision tree. I have tried to bring all institute questions at one place in various study material, RTP, MTP, past exam, and surely you will be benefited from that. Next tool for risk analysis is simulation. Okay, what do you mean by simulation? Simulation means construction of a model to represent a real life situation which facilitates substitution of critical variables within the model. Sir, not understood. I know. Have you heard this word simulation? Simulation means creating a real life like situation. Real life like situation. And then doing testing. So testing in a controlled environment. Even if something goes wrong, it's okay because it is only a testing in a controlled environment. Before actual environment is tested, we are going to test in a controlled environment. That is simulation. Like for example, practical application is very high. Companies launch softwares. Suppose a company wants to launch accounting software. What it will do, after that software is programmed, coded, whatever you call it, they are going to put dummy data in that. They are going to put dummy data and they will see whether the software is giving the desired outcome or not. So that is software testing. They are doing simulation. they are going to put lots of data, thousands of data, crores of data, because the accounting software must give the correct answer. It cannot afford to give wrong answer. Later on your balance sheet will not tally if something goes wrong in the software. So after lot of trial, lot of dummy data, then they are going to launch the product. That is called simulation. Nowadays, if you go for car training, suppose you want to learn car driving, car training schools, they have simulator. Have you seen that? Yes. Have you seen the simulator in a car driving school? Yes or no? So you will be made to sit in a driver seat. There will be a screen in front of you. You will have your steering wheel, clutch, gear, brake, accelerator, everything. You will feel as if you are driving the car on the road. So some truck will pass, some school going children will pass, and then you are given training. Even if you make some accident here and there, it's okay. You are in a controlled environment. Or pilots who learn to fly aeroplanes, they are not directly trained on the aeroplane. They are trained in the simulator, where they will get experience as if he is actually flying the plane. All the effects will be there. That is also simulator. Okay, and they will do it again and again to see the outcome. And once they are confident, then it is actually applied. Okay, even the bombs, atom bombs, are tested in simulation model. That is, they are not going to go and drop in some country and check what is the power of that atom bomb or energy of that atom bomb. Nowadays it is simulated. It is done on a computer screen, and they are able to understand what is the power, energy, or whatever variable they are testing will be achieved using this bomb. In your office also you do simulation. Client says, I want to pay so much of tax. You have a format ready. You will put the tax value here, and you will get how much income is required to be shown. Keep changing the tax value. Income will be changing. Reverse working is also happening in your offices. Yes or no? Please confirm. I will not reveal your name. That is also simulation. Oh, people have replied in yes. This is what is happening in your office. I need to complain. But as I promised, I will not complain the name of yours or your bosses. That is simulation. You are changing the data and seeing the outcome. Then why we are discussing it here? In capital budgeting also, we can apply the simulation technique for understanding the riskiness of the project. So what we do in simulation, in capital budgeting, we will first define how the NPV will be calculated. So I'll prepare one NPV model. NPV is calculated like this: selling price minus variable cost into quantity minus fixed cost. That will give me annual cash flow into PV annuity factor minus initial investment. This is just a simple example because we can introduce depreciation also, taxation also, salvage value also, so many things. So whatever are your variables, you define them and you make a mathematical model. Okay, now if I change any variable here, my NPV will change. Is it right? So I am going to now identify out of these variables which variable I need to keep constant and which variable I need to change, which variables I need to keep constant. For example, I may decide to keep discount rate constant. I won't change discount rate again and again. Years, number of years or life of the project, I may decide to keep it constant. But I may think that selling price can change, selling quantity can change, variable cost can change, fixed cost can change, initial project cost can change. So I am going to apply a simulation model by changing these different possible parameters and see what will be the outcome. So basically you are going to test the model by changing variables again and again multiple times and see what is your NPV. After doing tens and hundreds of trial, if you find that your average NPV is positive, you may decide to go ahead with the project. That is how simulation model works. So instead of dealing with one set of numbers or few possibilities, here we can change many variables many times and check the output and check the result, and that way you will be able to understand what if so much variable changes, so many variable changes, what will be the outcome. Is it right? Now we'll read, you will understand, because once I create that story, the student are able to understand. Simulation means construction of a model. This is my NPV model. It can be applied in any field. It can be applied in schools also, movie making also, atom bomb also, kidnapping also. Don't do that. You will first do a dummy kidnapping and then you will do real kidnapping. You can apply in bank robbery also. First you will do dummy bank robbery using a dummy bank and then see whether everything goes well, and then you can apply in real bank also. But please don't try. It is wrong. Simulation means construction of a model to represent a real life situation which facilitates substitution of critical variables within the model. So make a model and identify which are critical variable, keep changing that model. This is better than decision tree approach, because in decision tree approach, if the number of alternative and the number of outcomes are too many, it becomes very cumbersome, very complex. For example, if the life of the project is 3 years and there are 3-4 outcomes, it will end up giving you many possibilities. Like suppose for each of the 3 period, there are 4 different estimate of cash flows. See the complexities in the decision tree. Decision tree will become very complex as the number of possibilities will increase, number of years will increase. Just if you have 3 years and 4 possibilities in each year, then the total number of outcomes at the end of 3 years would be 4 into 4 into 4, 64 possibilities. So decision tree also will not help in some cases because it becomes very complicated. So simulation will come to help you. Simulation is a quantitative method. Long back, you will not remember, in CA final there was a topic called, subject called QT, quantitative technique. Does anybody know that? Quantitative technique was a subject for 30 marks long back, and in that there was a separate topic called simulation. Now that simulation they have shifted to our AFM syllabus, but only dealing with capital budgeting problems, right? It can be for any other area of life also. The procedure describes a process by developing a model of that process. So first we have to develop a model how NPV is calculated, and then we are going to conduct a series of organized experiment to predict the probable outcome of that process in a given period of time. And then we are going to change the variable multiple times and see what is the outcome. So first we have to construct a model. Practically, for a complex question, we use spreadsheets, computers, Excel sheet to present a real life situation which facilitates substitution of critical variable within the model. So in your office you have a income tax calculation software where salary, house property, profits from business, capital gain, other source, deduction under 80, etc., and then your taxable income, tax liability. If you change any variable, this will change. So that is what you are doing. You are simulating what will be my tax liability given a particular information. To keep the story simple, because our objective is only understanding a problem of capital budgeting, what we will do, we will first define the model. In our case, the model will always be calculation of NPV of the project. Depending upon the data given in the question, you have to design how NPV will be arrived at. For example, if selling price is given, variable cost is given, quantity sold is given, fixed cost is given, then this will give me my annual cash flow before tax. If tax is also given, then 1 minus T I will do, that will give me after tax, then multiplied by PV NBT factor and minus initial cost. This is my NPV model with this data. For different questions, the model can be different also, right? That much you should be able to do now. Then there are so many factors affecting my NPV. I have to divide them into two categories. One is called parameter, one is called exogenous variable. Parameters means those inputs which are going to be held constant for all simulation run. That means we are not going to change some inputs, like for example, I can keep life 5-year constant. I am not going to experiment with life. Then I will keep, for example, discount rate 10% constant. Of course, you can do experiment with this also, but then you have to decide that yes, these two variables are not likely to change, these two inputs are not likely to change, but my selling price can change, my variable cost can change, my quantity can change, my fixed cost can change. Okay, tax rate I can keep constant, etc. Initial investment I may keep constant. And what about exogenous variable? That is those variable, as the name suggests, exogenous. It is external, outside the control of the decision maker, and which can change. Selling price can change, variable cost can change, and that can affect my NPV. So we are going to test this exogenous variable. Exogenous variable could be parameter could be live, discount rate, initial investment. This is what we are writing as an example. An exogenous variable can be selling price, variable cost, sales quantity. Step number 3, for each parameter specify a rupee value. For example, in our question, suppose we decide life 5-year, fix it. We decide discount rate 10%, fix it. We decide initial investment 1 lakh, fix it. So this you have to lock, this you don't have to change. But for exogenous variable, we have to assign a probability distribution in the ascending order of value, because exogenous variable can change. So we'll have to assign a probability distribution. Like for example, we can say selling price can be 20 rupees, 21, 22 with probability 0.3, 0.5, 0.2. So you have to check what are the various possible share prices, selling prices, and what are their probabilities. Then we'll compute cumulative probability. Cumulative probabilities. The selling price you will arrange in the ascending order of value. Don't write randomly, it has to be in ascending order of value. Probability and cumulative probability. We'll compute cumulative probability. Student is asking what is cumulative probability. 0.3, 0.3 plus 0.5, 0.8, 0.8 plus 0.2, 1. And then we'll generate random number class interval. Then we'll compute random number class interval. What is random number? Have you heard in your lifetime random number? Have you heard random number? Random number means Winman software. Yes. Random number means any number has equal probability of selection. Any number has equal probability of selection. If there are 100 numbers, every number has equal probability of selection, that is 1 by 100. If there are 1000 numbers, every number has equal probability of selection, 1 by 1000 will become probability. Is it right? Random number class interval. How do we compute it? First 30 numbers, class interval will be 0, 0 to 29. 0 is also one random number. Then it is 80, so the next class interval will be 30 to 79. 30 to 79. And then 1, so next class interval will be 80 to 99. So total 100 numbers are considered. Okay. This must be done by matching cumulative precisely with the probability assigned. This is a very easy mechanical calculation. Probability convert into cumulative probability convert into random number class interval. Now what is the use? Out of 100 numbers you have to pick any number randomly. Pick any number randomly. Just like in a box, suppose 100 numbers are there and you select a number, that is like a random number. Suppose that number comes to 55. I picked up a random number, it comes to 55. I will see where is 55 in this random number class interval. 55 will fall in the class interval between 30 to 79. So if my random number is 55, selling price will be 21. Then again I pick one random number, let us say it comes to 12. If my random number is 12, it will fall in this class interval and the selling price is 20. So now it is up to the decision maker how many times he want to do the experiment. So we'll compute NPV with 21 rupees selling price, we'll compute NPV with 20 rupees selling price. So this we will do for all exogenous variable. Okay. Normally in the classroom or in the exam, 4, 5, 6 random numbers are given for each exogenous variable. So it is within the manageable time. Then in real life situation, nowadays computer generate the random numbers and the computers will do the testing. And that is why this is a very important method of understanding the risk. You can do the experiment hundreds of times and see what is the effect on NPV. Assign random number to each exogenous variable and a certain value. For this use random number table and random number intervals of step 4. Random number will be given to you in the question. You can't use your own random number. Okay. and you have to repeat this exercise for all the random numbers by putting the values in the NPV model. Simple average of various values solved under step 1 will be the final value. So suppose you do the experiment 100 times, take average NPV. If that average NPV is positive, you will say accept the project. A capital budgeting exercise aims at assessing what the possible NPV of a project would be. So in capital budgeting, my model is NPV. For different situation, the purpose of simulation can be different, but we are going to restrict ourselves to simulation only. Today you do one small homework, read the theory question, advantage of simulation and shortcoming of simulation. Just simple plain English, read it, because I have never seen any theory question on simulation model. The only 2 questions they ask are printed in the book. We'll solve both these questions, and if they ask some different question, you will be able to solve based on 58 and 59. We are going to solve today question number 58. Source, write down the reference book. You are the CFO of AS Limited. Wow. Your company proposes to buy an equipment costing rupees 1 lakh. The equipment will last 5 years. Your cost of capital is 10%. Your analyst suggested that the expected revenue per annum could be 1 lakh, 1,25,000, 1,37,500 or rupees 1,50,000. So revenues can change. Similarly, cost could be 62,500, 75,000, 87,500 or 1 lakh. So cost can also change. The probability distribution of these are given below. So these are the probability distribution of revenue, and this is the probability distribution of cost. It is a simple statistical technique. Okay, as far as calculations are concerned, it is very simple and very mechanical, but it has got lot of real life application. You wish to run a simulation model and have picked up the random numbers 81, 2, 64, 46, 31, 67, 25. These are random numbers. They have randomly picked up some number and you got these numbers alternatively for revenue and cost. What do you mean by alternatively for revenue and cost? It means the first random number 81 is for revenue, second random number 2 is for cost, 60 is for revenue, 4 is for cost, 46 is for revenue, 31 is for cost, 67 is for revenue. These are the random numbers for revenue and cost. If you don't read the line carefully, you may make a mistake. Decide whether the project can be undertaken or not. So we'll have to basically first find out what are the revenues possible. What are the cost possible? What are the revenues possible? What are the cost possible? And for that we have to make random number class interval. I am going to ask you some questions. First is, which are the parameters in this problem and which are the exogenous variable in this problem? So first you can answer parameter, which we are going to keep constant in all the experiment. One is the equipment cost 1 lakh. Next is life, 5 years. Discount rate. Discount rate. Where is the discount rate? Discount rate 10%. This I am not going to change. What I am going to change? Revenue and cost. Revenues and cost. These are going to change. Okay. So you can write in your notebook if you want. In the given question, parameters are equipment cost 1 lakh, life 5 years, discount rate 10%. Next line, exogenous variables are revenues and cost. Exogenous variables are revenues and cost. Exogenous variables are revenues and cost. Exogenous variables are revenues and cost you have written. Now first I need to prepare probability distribution table and class interval for revenue. Probability distribution table and class interval for revenue. Very easy question. Only some process you have to understand. That is how to make use of random numbers. Otherwise question is very easy. Make a table with 4 columns. First is revenue. Second is probability. Third is cumulative probability. Fourth is class interval. So revenue, write down. Revenue is 1 lakh. Probability is 0.15. Cumulative probability will be 0.15. What will be the class interval? Come on, class interval. First 15 numbers. Class interval will be 0, 0 to 14. 0 is the first number and next 14 number. Very good answer. Next 1,25,000, 0.40. Cumulative will be total of 0.40 plus 0.15 and the class interval will be 15 to 54. 1,37,500. 0.30, 0.85. Class interval will be 55 to 84, right? 1,50,000, 0.15, 1. Class interval will be 85 to 99. We are going to check in which class interval the random number falls, and that will be the value of revenue for that random number. So random number identify in the class interval and then identify revenue for that class interval. Now please do one exercise for me. Calculate random number class interval for cost. Write down step 2, probability distribution table and class interval for cost. Same format: cost, probability, cumulative probability, class interval? Cost I have given to you. Probability is given in the booklet. Probability is given. Please compute yourself cumulative probability and class interval. After 30 seconds I will check. After 30 seconds I will check. Once it is over, inform me. Once it is over, please inform me. Cumulative probability is 0.10, 0.35, 0.70 and 1. This is cumulative probability. Then class interval, check. Those who have done will check. 00 to 09, 10 to 34, 35 to 69 and 70 to 99. After completing this random number class interval, now we are going to pick the random number and assign values to that random number. So please go to step number 3, random number and ascertainment of value for revenue. Random number and ascertainment of value for revenue. So 3 columns: random number, class interval, revenue. From the random number I will identify class interval in which that random number falls, and from class interval I will find what is the possible revenue. 81. Now go to your working note 1 and tell me in which class interval 81 will fall. Come on, I want answer from you. In which class interval 81 will fall? Yes, reply. Which class interval? The student has replied 55 to 84. You are right. Very good. And what is the revenue for this class interval? Revenue, first column, 55 to 84. Go to the first column. You have given correct answer, 137,500. 60. I think 60 will also fall in the same class interval. So 60 will also have same answer. 46. Yes, reply this time. What is the class interval for 46? Come on, class interval for 46. 15 to 54. Very good. And what is the revenue for this class interval? 1,25,000. Very good. 67. 67 will again fall into 55 to 84 only. 55 to 84 and the answer is same. So we have conducted 4 experiments because we are in the classroom. Companies can do 15 experiment, 100 experiment because they want to be sure they are putting their money. You are a student, your money is not invested. But for the corporate, they would think this can also happen, this can also happen, this can also happen. Okay. And therefore, my total in 4 trial is 537,500. Average revenue 134,375. 134,375 is my average revenue. Now I am going to repeat the process for cost also. Step number 4, write nicely in good handwriting. You should be able to read your own notebook. That should be the handwriting, and institute should be able to read your answer sheet. If these 2 purpose is satisfied, any handwriting is okay. You should be able to read, institute should be able to read and understand. So write down random number and ascertainment of value of cost. 3 columns again: random number, class interval and cost. So as we discussed in the question, the 2nd, 4th, 6th and 8th random number given in question are for cost. So 2nd random number in the question is 2. It will belong to which class interval? First class interval, 00 to 09. And what is the cost for that? The cost for that is 62,500. Then the next random number is 4. This will also belong to this class interval. This is the cost. The next random number is 31. You will reply now. You will reply what is the class interval for this. One student has replied 10 to 34. Very good. And the cost is 75,000. Next 25. Same answer. Same answer. Total cost in 4 runs. They are called runs or trials. So the answer is 2,75,000 and the average is 68,750. The average is 68,750. The average is 68,750. Okay. So I've got average revenue. I've got average cost. Can I compute average annual cash inflow now? Step number 5. Expected annual cash flow. Expected annual cash flow. Average revenue minus average cost. Average revenue minus average cost. After conducting experiments, we found that my average revenue is 134,375. That is likely to happen. And my average cost likely to happen is 68,750. So because of this, my average cash inflow would be 65,625. This is my average cash inflow. And now I can compute NPV. Now I can compute NPV. Life of the project, discount rate, initial investment we are not going to change. So compute NPV, draw this table with 5 columns: year, particular, cash flow, discounting factor at 10%. Last column is DCF, discounted cash flow, or you can write present value, doesn't matter. Year 0 cost of the project 1 lakh. Year 0 cost of the project is 1 lakh. Present value 1 lakh. For 1 to 5, annual cash flow will be 65,625. In bracket, step 5. In bracket, step 5, compute the factor. Just check it. 3.7908. Check it first. 3.7908. Yes. Multiply 248,771. 248,771. Take total 148,771. 148,771. This is my NPV, and you write one note. As the expected NPV is positive, write one note. As the expected NPV is positive, the project should be accepted. As the expected NPV is positive, the project should be accepted. Okay? The project should be accepted. So you have to write the conclusion. There is one more way we can solve it. One is solving 5 times NPV. Solving 4 times, sorry. For every revenue and cost, compute NPV. Again, for second revenue and cost, compute the NPV. And then you can take the average of the NPV. Is it right? That can also be done. But that will take more time. Your final answer will be the same. So I am going to solve next question. We are going to solve NPV for each run. NPV for each random numbers run. Let us see. Question number 59. Please mark important. Please mark important for the exam, because you don't have too many varieties of question on simulation. These are the 2 types of question I found, and if they ask any question, it will be around this only. A project involves an initial outlay of 250 lakh. it has a life of 5 years and salvage value 10 lakh. So one more variable they have added is salvage value. There is uncertainty regarding the price per unit, variable cost per unit and quantity. So this time price, variable cost, quantity, these are exogenous variable, they can change. There are 3 possible prices with this probability. There are 4 possible variable cost with these probabilities, and there are 3 possible quantities with these probabilities. Question is compute 3 simulated NPV. So 3 times you have to compute. 3 times NPV you have to compute using the following random numbers. Risk-free interest rate is given 6%. Fixed cost, cash fixed cost is 2 lakh. So that also we'll have to consider in the NPV model. First run. Random number for selling price 72, variable cost 17 and for quantity 65. That means for these random numbers, first we will have to find out what will be the price, what will be the cost, what will be the quantity, and compute NPV based on that price and variable cost and quantity. Then I am going to do second run. In second run we found following random numbers. Based on this set of random numbers, what will be my NPV? And same thing for the third run. So this question specifically requires you to compute 3 NPV for 3 runs. Is it right? So what I am going to do first I am going to prepare random number class interval for price, for variable cost and for quantity like the previous one. So I will ask you to do little fast. Write down step number 1. Random number class interval for price. Random number class interval for price. Please participate in the discussion. Then only there is an enjoyment of learning. Price, probability, cumulative probability, and the last column is random number class interval. Random number class interval. So start. Price is given in the question 20, 25, 30. Probability of price is given 0.2, 0.4, 0.4. Cumulative probability will be 0.2, 0.6 and 1. You will write class interval, I will check. You will write class interval, I will check. If the random numbers are given in 2 digits, then class interval also will have 2 digits. But if random numbers are given in 3 digits, class interval also will have 3 digits. Okay. Anybody for the first one? Class interval 00 to 19. Very good. Next. 19 to 59. Check. 19 to 59 is right. And the last one 60 to 99. 60 to 99. Is it right? Just tell me yes, it is right. Then we'll go to the next. The second one is wrong. You are right. This should be 20 to 59. 20 to 59. Very good. Any other question? No. Now write down random number class interval for variable cost. Random number class interval for variable cost. 4 columns again. 4 columns again. Variable cost, probability, cumulative probability, random number class interval. Variable cost 10, 12, 14, 16. 4 variable costs are given. Possible 4 variable costs are given, and the probability is given 0.1, 0.3, 0.25, 0.35. Cumulative probability 0.1, 0.4, 0.65 and 1. Please write the class interval yourself. Write the class interval yourself. If you want to copy, you have to wait. For those who have decided to copy only, you will have to wait. Okay, now check. 00 to 9, 10 to 39, 40 to 64, 65 to 99. 65 to 99. Is this right? Is this random number class interval right? Say yes or no, whatever you think. Okay, this is right. One more chance. Random number class interval for quantity. Random number class interval for quantity. Quantity, probability, cumulative probability, and random number class interval. Quantity 10, 12, 15. Quantity is given. Probability is given 0.2, 0.3, 0.5 is right. Cumulative 0.2, 0.50, 1. What will be the class interval? 00 to 19, 20 to 49, 50 to 99. Just confirm, is this right? Is this right? Everybody, please answer yes or no. Yes. So now we have done this random number class interval. Step number 4, write down design NPV model. Design NPV model. How do we reach NPV? Either we can prepare 3 separate tables or we can solve it by a formula. NPV equal to big bracket, small bracket, price minus variable cost, that is contribution, into quantity, that is total contribution, minus fixed cost. This continues, it's a very big formula, minus fixed cost, that will give you cash inflow, into PV annuity factor 6%, 5 years. This is for PV of annual cash inflow. And in this question you have salvage value also. Salvage value will be received in the 5th year. Salvage value into PV factor in bracket 6%, 5 year. Salvage value will be received at the end of 5th year minus initial project cost. Minus initial project cost. Is it right? Minus initial project cost. Have you understood the formula? Have you understood the formula? Please say yes or no or don't know. Okay. Write down below. For price I can write P. For variable cost I can write V. For quantity I can write Q. These 3 are the missing variable, P, V and Q. Fixed cost is 2 lakh. Fixed cost is 2 lakh minus 2. And the PV annuity factor for 6% and 5 year, please check. PV annuity factor is 4.2124. 4.2124. Salvage value is 10. Salvage value is 10 into PV factor for the 5th year is 0.7473. Is 0.7473 minus 250. So I put the values also. So now in the 3 runs only you have to change these three values. Only you have to change these three values and you will get the NPV. Is it right? Is it right? Have you noted this formula? So when you will do the trial, change the value of price, variable cost and quantity, other numbers are logged. Have you noted down? Have you noted down the formula? Okay, nothing great, it is very simple. Now write down the step number 5, calculation of NPV. Calculation of NPV. Draw this table with 5 columns. Draw this table with 5 columns. Run, price, variable cost, quantity, NPV. First run. Now keep your question in front of you. In the first run, random number for price is 72. Okay. Go to your random number class interval for price and check in which class interval 72 will fall. In which class interval 72 will fall. So 72 will fall in the class interval 60 to 99, and for class interval 60 to 99 the selling price is 30 rupees. I am writing directly, otherwise we'll have to prepare 3 more working notes. Understood? Variable cost in the first run is random number is 17. 17 will fall in class interval for variable cost 10 to 39. For 10 to 39 the variable cost is 12. Is right? Quantity. Quantity, random number for quantity 65. 65 will fall into class interval 50 to 99, and for class interval 50 to 99 your quantity is 15. Can you check that? Please check, then write. For class interval 50 to 99 quantity is 15. Now what I'll do, I have already given you NPV model. Put the values in that NPV model. Put the values in that NPV model. Selling price 30 minus variable cost 12 into 15 quantity minus 2 fixed cost. Put all this in one bracket, multiplied by PV annuity factor 4.2124 plus present value of salvage value. This is PV of salvage value 10 into factor, and this is your project cost. Please only check the calculation. I have not checked. You have to check and tell me yes or no. Yes, please reply yes or no. 886.40 approximately. 886.40 approximately. Is it right? Is 886.40 right? Please confirm. Then only we can proceed further. Is 886.40 right? If there is a huge difference, then inform me. Please reply, otherwise I'll keep waiting. It's not a rocket science calculation. Yes, very good. Go to second run. Second run, question in front of you. Random number is 95 for selling price. 95 will fall in class interval 60 to 99, and for 60 to 99 the price is 30. Correct? Random number for variable cost in second run is 35. 35 will fall in class interval 10 to 39, and the variable cost for 10 to 39 class interval is 12. Once again, random number for quantity is 99. 99 will fall in the last class interval 65 to 99. For 65 to 99 quantity is 16. Sorry, 15. Quantity is 15. Quantity is 15. Is it right? 50 to 99 is the class interval. Quantity is 15. First you confirm whether this price, cost, quantity is correctly identified. Yes. If the answer is yes, now be careful. These three numbers and these three numbers are same. Don't waste your energy. Same answer, because price, variable cost and quantity both are same. One last chance to you. This you will try. Third run. You will try. Give me the correct answer here. Then I will understand that you have understood this simulation model. You will try, I will check. I am waiting for your answer. The moment you get the answer, please inform me. Good students will try, others will wait and watch and copy. Third run, random number is 62 for price. 62 will fall in the third class interval whose value is 30. Variable cost, random number is 52. It will fall in the class interval 40 to 64. The value is 14. Quantity random number is 2. It will fall in the class interval 0 to 19. Quantity is 10. Put the values and solve. Put the values and solve. The answer is, one student has given correct answer, 423.03. 423.03. Very good answer. So we have completed this simulation also. Today what you do, just practice what we have done. No homework on simulation. Now the next part of this chapter is real options. This we have discussed in option chapter also. There are two types of options: financial options, real options. Financial options are on financial products like equity, bond, index, but real options are on physical assets or tangible assets like machine rather than financial instrument. As the name suggests, an option is a right but not the obligation to undertake some business decisions after the project have been implemented. In capital budgeting also, sometimes we have options once we start the project, and these options helps us to improve the NPV of the project. For example, in last 6 to 7 days, we have taken, suppose life of the project is 5 years. We have assumed that we have to compulsorily go up to 5 years. But that is not necessary. You can have an option to abandon the project. Abandon means you terminate the project before maturity if that option exists, so that you don't have to suffer further losses. If you think that I am going to incur losses if I continue, but if I can shut it down, I can save the losses, then it is better to shut down if that option to shut down or if the option to terminate exists. Sometimes we may start a project and then we want to expand it. That expansion option, if available, then we can exercise that option if it is profitable, and we can further increase the NPV of the project. So real options are options embedded in the project which will enhance the value of the project. Options to modify the projects are called real options. Real option refers to options which are embedded in the project. These are options on tangible asset like machine, project rather than financial instrument. So in our syllabus we have to discuss real options like option to abandon. Option to abandon means option to terminate the project during its life. We'll discuss in detail as we'll go ahead. Life of the project is 5 years, but you can terminate it after year 1 or 2 or 3 or 4. That option may be there, that in case if you don't want to continue, you can terminate it. So we'll have to learn how to take decision whether to abandon the project or not. Second is option to replace. This probably you have studied in capital budgeting chapter. Option to replace means whether we should continue with the old asset or replace it by a new one. This is very easy, already taught in the basic capital budgeting classes. Third is option to expand. That is, this option helps us to expand the business after a certain number of years. And important one on which we have a lot of questions also, option to postpone. Option to postpone means should we start a project today? Should we start a project after 1 year? Should we start a project after 2 years, like this? That is called option to postpone. The advantage of postponement is that you will get more information. You are waiting for some information. You are waiting for the election to get over. You can start a project today. You can start a project next year. If you start a project next year, there is an uncertainty about which party will come into power, because accordingly your project can get impacted because of that. So should you wait for 1 year or should you start now? That is called option to postpone. Option to wait before investing. Such option allow a firm to delay in investment until it is sure about other relevant issues. More information will be available, but of course we have to answer on the basis of numbers. Numbers will speak what we are supposed to do, not on the basis of emotion. If numbers tell it is profitable to start now, start now. If the numbers tell it is profitable to postpone, we'll postpone. But today's topic is option to abandon. Abandon means to terminate, to leave the project before completing the expected number of years that we thought in the beginning, right? This is called option to abandon or cease or terminate the project during its life. Most of the questions that you have solved in your life till today, you were given 10-year life and you thought that I have to necessarily go till 10 years. The answer is no. If you have option to abandon, and if abandonment gives you more profit, you can abandon the project. For example, suppose a project has a 5-year life and we have completed 4 years. I can salvage the project and I will get suppose 100 rupees. I will terminate the project, suppose at this point I will get 100 rupees salvage value, but if I continue till the 5th year, let us say I will get 100 rupees at the end of 5th year also, but these two are not comparable. If I compute the present value of this 100, present value of cash flow of 5th year, 100 divided by 1 point say 10%. How much is that? Can you please help me? 100 divided by 1.10. It is something around 91, let's say. By continuing for 1 year, I will get 91. But by terminating the project today, I will get 100 rupees. What is better? Terminating at the end of year 4 and getting 100 rupees is better, or continuing till the end of 5th year and getting 100 rupees is better? Answer is obvious. Time value of money is also important. So I will be better off by terminating at the end of 4th year. Is it right? So this is how we'll take the decision. We will simply compare what is the abandonment value and if it is greater than continuation value, then the answer will be abandon. If by abandoning a project your value is more, then by continuation it is better to abandon the project. Like one example is given here, good example on which we have a question also. Point number 2 first. This option helps in eliminating further loss when the event turns unfavorable. Because once you start the project, you may not get the same result which you are expecting. Then it is better to abandon and avoid losses. Like a gold mining company has the right to mine the gold. There are two things. There is a cost of extraction of the gold and there is a gold price. But it can happen that gold price is less than cost of extraction. Gold price is less than cost of extraction. Would you continue or would you shut down? The answer is it is better to shut down and it is better to abandon because gold price is less than cost of extraction. So you will suffer the loss if you continue. One more example. Suppose it's a very competitive industry and there is overcapacity. There are more suppliers than buyers. Supply is more than demand. So you know that if I continue, I would suffer the losses. So it is better to stay. It is better to get out. So that is, if you want to get out, if that option of getting out is there and if that is more profitable, it is better to get out. With the ability to abandon, the worth of an investment project would be enhanced. If the project has the option to abandon, we will see in the next two questions, the NPV can be enhanced. NPV will increase if you have that abandonment option with you. Is it right? So first we'll take a break for about 10 minutes and then we will assemble again after 10 minutes. Enjoy the break. Don't abandon. Okay, come back. Abandon is the topic, but you are not supposed to abandon the batch. Please come back after 10 minutes.
माझा तो ब्रँड मोबाईल आहे नाही आहे आता मी तुला नाही मोबाईल वाटला मग एकदा बघा कोणाकडून मिस कॉल तर घ्यावा कोणाकडून मला नंबर तर मागावा म्हणूनच म्हणलो हे मोबाईल फोडतो बाबा म्हणून म्हणूनच म्हणलो मी ऐका नाही मोबाईल कामावर तिथंच आहे दुसरीकडे कुठे जाऊन पाणी काढायला काय करावं त्याला झाले म्हणजे आपल्याला काय कुठं 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 दिवले फोन आहे सत्या कुठे सुखरूपी किती आणि काय तुम्ही सदा सदा विकत राहते मग अर्ध 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 तरी इकडं घालतात की वीज तोडते 4,000 आता दिवाळी भाऊ तुम्ही याच्यावर नंबर मिस कॉल मारा का मोबाईल बंद आहे नंबर घेऊन तर लावा का मी ह्याला बी आत्ता लावलेला आहे ना गॅस वाचले मला माहित नाही
Okay, can we start now? We are back. Just 1 second, please. Okay, so we're starting now. Next is decision making when there is an option to abandon. First is when the present value of the remaining cash flow falls below the liquidation value. Then the answer is abandon. Abandonment means if you find that continuing option will have lower present value, then it is better to abandon the project. Okay, continuing option has lower present value than the salvage value you will get. It is better to abandon the project. But if you find that continuing option will generate more value in present value terms, then liquidation value, do not abandon. So simply put, whichever gives you more benefit. Abandonment gives you more benefit, abandon. Continuation gives more benefit, continue. Worth of the project with abandonment option will be NPV without abandonment option plus the value of the abandonment option. Is the project worth? Project value goes up because you have abandonment option also. Reverse question, your dear institute will ask you what is the value of abandonment option. So it is equal to NPV with abandonment option minus NPV without abandonment option. And this question they have asked in the exam also. Find the value of abandonment option. That will take after some time. But first let us go to question number 60. When the project has the option to abandon, we are going to demonstrate that the value of the project will go up. Question number 60. Source, write down reference book. First we will start with one easy question so that we will get some confidence, and then we can increase the variety, increase the complexity of the question. I hope you are ready. Question number 60. A project having a cost of 20,000, an economic life of 5 years is being evaluated on the basis of the following information. So this is a very basic question. Initial cost is 50,000. Initial cost is 50,000. You can continue with the project for 5 years, and these are the inflows you will get if you continue for 5 years. But you can also abandon the project. If you abandon the project at the end of year 1, you will get 14,000. If you abandon at the end of year 2, you will get 10,000. If you abandon at the end of third year, you will get 6,000. If you abandon at the end of fourth year, you will get 2,000. And in the fifth year, in any case you have to abandon and you will not get any amount. Very good question for understanding the option to abandon. The project may be evaluated in terms of its NPV. First we will see NPV of the original estimate, that is go up to 5 year. The rate of discount is 10%. Suppose the possibility of abandonment exists. When should the project be abandoned? When should, whether you should abandon in year 1, 2, 3 or 4. In any case, the maximum you can go is up to 5 years. So first I will answer the original question, whether the project is acceptable based on original estimate. Write down step 1, calculation of NPV. Step 1, calculation of NPV. Step 1, calculation of NPV. Under that you write down year, particulars, cash flow, discounting factor at 10%, discounted cash flow. Year, particular, cash flow, discounting factor at 10%, discounted cash flow. Discounted cash flow can be written as present value. Please write year 0 cost of the project. Year 0 cost of the project 20,000. Year 0 cost of the project 20,000. Year 1 cash inflow 10,000. Year 2 cash inflow 8,000. Year 3 cash inflow 6,000. Year 4 4,000 and 5 2,000. If you are going to go up to 5th year, then the scrap value given to you is not important. Scrap value given to you is not important because you are going to continue for 5 years. Please write the factor 1 divided by 1.10, 0.9091, 0.8264, 7513, 6830, 6209. If you want, you can directly calculate the present value. That is also okay. You can directly calculate the present value. So anybody who would like to tell me quickly what is NPV? Please respond fast. What is NPV? School level question. 10th standard student can also do it. The first part. What is the NPV? What is the NPV? Anybody NPV answer? Check 4184. Check 4184. Very good. 4184 is right. Amazing. Now the next question is, suppose if we have the option of abandonment. If we want, we can abandon the project at any time after 1 year, 2 year, 3 year, 4 year. Should we abandon? And if yes, in which year we should abandon? And for that, I will compute NPV. If we abandon the project at the end of year 1, what is my NPV? If I abandon at the end of year 2, what is my NPV? If I abandon at the end of year 3, what is my NPV? And if I abandon at the end of year 4, what is my NPV? This is one way to solve. Wherever my NPV will be maximum, in that year we are going to abandon. Okay, so very easy, only have to solve 4 times. Draw this table first. Draw this table first. First you write down step number 2, evaluation of the proposal to abandon the project. Evaluation of the proposal to abandon the project. Evaluation of the proposal to abandon the project. Under that, write down this table with total 10 columns. If you don't want to write discounting factor column, you can ignore only that column, but other columns you have to write. Year, discounting factor at 10%. Under that, year 1, cash flow present value. Year 2, cash flow present value. Year 3, cash flow present value. Year 4, cash flow present value. Write down in year column, year 0, 1, 2, 3, 4, because 5 year we have already done. 5 year calculations we have already done. Now write down the factors, please. Write down the factors. If you don't want to write factors, then it is okay. You can directly do on calculator. Now we are going to understand year 1. Suppose I want to abandon at the end of year 1. Suppose I want to abandon at the end of year 1. Year 0 cash flow will be 20,000, and in year 1, question in front of you, 10,000 your cash inflow from operation and 14,000 from scrap value. 10,000 from operation, 14,000 from scrap value. Your total will be 24,000. Total will be 24,000. Is it right? Is 24,000 right? 10,000 and liquidation value, scrap value 14,000. So you will get 24,000. Now you compute present value 20,000. Second answer is 21818. Please take the total. If you abandon at the end of year 1, your NP will be 1818. NPV will be 1818. Suppose you want to abandon at the end of year 2, let us write cash flows up to year 2. Year 0 will be 20,000. Year 1 cash inflow 10,000. Don't write 14 because I am going to continue till second year. I will get second year 8,000 revenue or cash flow from operation, plus I will get 10,000 scrap value. If I terminate the project at the end of second year, I will get 8,000 plus 10,000, 18,000. Multiply by these factors. and take the total 20,000, 9091, 14875. Anybody for NPV in the last line? NPV, NPV, come on, NPV, NPV. How much is the NPV? 3966. Is it 3966? Okay. Year 3. Now you've understood what you have to do. Suppose I go up to third year. I will get cash flow of the first year 10,000. I will get cash flow of the second year 8,000. But in the third year, I will get cash flow from operations and scrap value 6,000. So my total will be 12,000. Is it understandable? Now please compute the NPV. That much you can do. Compute the NPV by multiplying by these discounting factors. Multiply cash flows and discounting factor. Yes, anybody who got the total? Little fast. Total of this is 4718. 4718. Is it right? 4718. That is, if I abandon after 3 years, I'll get an NPV of 4718. I'll get an NPV of 4718. Now go to year 4. Year 4. Now you write down all the cash flows 10, 8, 6. In the fourth year 4,000 revenue from operation and 2,000 scrap value 6,000. Take these factors, multiply by cash flows and also take the total. Use memory plus function. Student should write fast. Sometime you should play smart. Already here we have done the calculation. For the same cash flow we'll get same answer. Only here we'll change 6,000 into 0.7513. 6,000 into 0.6830. Total 4308. Total 4308. And we have also done calculation for year 5. Can you please tell me what was the NPV if we go up to year 5? Can you please tell me that figure? That figure was, I think, 4184. Okay, now we have to make a choice between these 5 NPVs. Which NPV is highest? This is highest. Can you see 4718 is highest? So the answer is you should terminate the project at the end of year 3. You should terminate the project at the end of year 3. You should terminate the project at the end of year 3. So write down the conclusion. Write down the conclusion. The company should abandon the project after 3 years. Company should abandon the project after 3 years as the NPV will be maximized. As the NPV will be maximized. This is one way to solve, and this is a foolproof method. You can't make mistake. That year which gives maximum NPV, in that year you should abandon. Okay. There is one more way. I will solve by one more method, so that whichever method you find convenient, write down alternative method. alternative method, we'll draw one table abandonment at the end of dash. Abandonment value means scrap value. Continuation value. Continuation value. This will be a little bigger column, and the last column is decision. So first we'll try abandonment at the end of year 1. First we'll try abandonment at the end of year 1. If you abandon, you will get 14,000. If you abandon at the end of year 1, you will get scrap value 14,000 today at the end of year 1. But if you continue, you will get future cash flows. Can you see 8,000 divided by 1.10 plus you will get 6,000 after 2 years from that date divided by 1.10 to the power 2, because 1 year is over, so now the gap is 2 years. Then 4,000 divided by 1.10 to the power 3, and you will get 2,000 divided by 1.10 to the power 4. This is what you will get if you continue. So you will have to now do the calculation and answer. 8,000 divided by 1.10 equal to memory plus 6,000 divided by 1.10 2 times equal to memory plus 4,000 divided by 1.10 3 times equal to memory plus 2,000 divided by 1.10 4 times equal to memory plus memory recall. So that is 16,602.69. Just check the calculation. Is it 16,602.69? Is it 16,602.69? This is more. So the decision is continue. Don't abandon at the end of year 1. Continue. Continue. Suppose we abandon at the end of year 2, I'll get scrap value 10,000. 2 years are over. 3 years are remaining. So next 3 cash flows, if I continue, I will get 6,000 after 1 year from end of year 2. I will get 4,000 after 2 years from that date. So discount by 2 year factor, and I'll get 2,000 after 3 years from that date. So please check the answer. 6,000 divided by 1.10 equal to memory plus 4,000 divided by 1.10 2 times equal to memory plus, and 2,000 divided by 1.10 3 times equal to memory plus memory recall 10,262.96. Decision is continue, because continuation value is more than abandonment value, is right. And one more, year 3, if I abandon, I'll get 6,000. At the end of year 3, I'll get 6,000. If I continue, I will get 4,000 1 year from the end of year 3. So that will discount by 1.10. and I will get 2000 divided by 1.10 to the power 2. Two future cash flows will get 4000 divided by 1.10 equal to memory plus, and 2000 divided by 1.10 2 times equal to memory plus memory recall, that is 5289.26. Now abandonment value is more. Can you see abandonment value is more? So abandon at the end of third year. We got the same answer. Two different methods, but the answer is same. Whichever one you have understood, you can follow. Okay, whichever one you have understood, you can follow. So this is the question on abandonment. Now we'll go to question number 61. Source of this question is RTP. RTP, past RTP. A very good question. Write down very good question, likely question for exam. AS Limited is evaluating a proposal costing rupees 3 lakh and an economic life of 2 years, over which expected cash flow together with probabilities have been estimated as follows. These are rupees in 1000. This project has life of 2 years. Year 1, year 2. In first year, either you will get 200 or 300 or 400 with these probabilities. Okay, and suppose you get 200 in year 1, then year 2 cash flow can be 100, 200 or 300 with these probabilities. If you get 300 in the first year, these are the cash flows of year 2 with these probabilities. If you get 400 in the first year, you will get 300, 400, 500 with these probabilities. The student will recall we have done a similar question in the classroom. Do you remember a similar question in decision tree approach we have done? Do you remember similar question on decision tree we have done, and you had done homework also? Some of you, not everybody. You think homework is a torture. You will realize on the day of the exam, those who are ignoring the homework, calculate the mean of the probability distribution of the possible NPV. The first question means find expected NPV. First question means find expected NPV, which we have done, I think, yesterday in one problem. Is it right? Don't ignore. You are spending so much time in the office, but you have to also spend time on learning, because ultimately your value will increase, personal value, only if you pass the exam. Otherwise you will keep on working. The rate of discount is 12%. So that is 12% for discounting. This is one question which we have already done. Now they have added one more question in this. Calculate the new mean NPV assuming the company abandons the project if it is worthwhile to do so. That means suppose the company can abandon the project if it is worthwhile to do so. That means if abandonment will give more value, then it can abandon the project. The abandonment value at the end of year 1 is 2,50,000. If you abandon after year 1, the scrap value is 2,50,000. This question we will solve later, but at least the first part, which we have already done in previous lecture, let us complete that question. And there is no need to draw decision tree, not specifically asked. Only compute mean NPV. Mean NPV means expected NPV. So please write down step 1. This should have been given as homework, but because some students don't do homework, they are over busy with their office work. I have to solve it in the class because my second answer depends on the first answer. Is it right? My second answer depends on the first answer. Calculation of mean NPV or expected NPV, year 1, under year 1 2 columns, exactly same problem we have done, and it was given as homework also. Cash flow, discounted cash flow, the PV factor for 12% and 1 year, 1 divided by 1.12, 0.893. This is the present value factor of year 1. This is the present value factor for year 1. Year 2, cash flow, discounted cash flow. Second year factor, 1 divided by 1.12, 2 times equal to total PV of cash flow. Total PV of cash flow. Then write cost of project. Cost of project, NPV, joint probability, expected NPV. Rupees in 1000 write down. Rupees in 1000. Top right hand corner, rupees in 1000. That will save time for us. Column numbers also will write down. Column numbers write down. These are column numbers. 1, 2, 3, 4. 5 is 2 plus 3, 2 plus 4, 6. 7 is equal to 5 minus 6. 8. 9 will be equal to 7 into 8. 9 is equal to 7 into 8. Then write down 200, 300, 400. Keep 3 lines gap. 200, then 3 lines gap. 300, then 3 lines gap. Then 400. And the discounting factor is already I have written 0.893. First number multiply 0.893 into 200. 178.6. Now just press 300 and press equal to. That will give you present value of 300. Just press 400, press equal to 357.2. Is it right now? Now year 2 cash flow depends on year 1. Copy from the book quickly. Same numbers copy 100, 200, 300. 200, 300, 400. 300, 400, 500. All this you have to multiply by second year factor 0.797. First number multiply 0.797 into 100 equal to 79.7. Press 200, press equal to 159.4. Press 300, press equal to 239.1. Wait. These two numbers are getting repeated here. So why don't you just copy it again without wasting time? 159.4 and 239.1. 400 press equal to 318.8. Wait. 300 and 400 are repeating here also. Copy these two numbers. Save time. 500 press equal to 398.5. Any query on this? You have to attend the previous lecture to understand this entire thing. It was discussed in detail. Now we'll go to PV of cash flow total. 178 plus 79.7. If this path takes place, your PV will be 258.3. 178.6 plus this number 338. 178.6 plus this number 417.7. 267.9 plus 159.4. 427.3. Very good. Next 267.9 plus 239.1. 507. 269.7.9 plus 318.8. 586.7. Try the next one. 357.2 plus 239.1, 596.3. This number plus this number, 676, and one more last, 755.7. Question is from RTP of your institute only. What is the cost of the project in rupees in thousand? Cost of the project is 3 lakh. So we are going to write 300 rupees in thousand. Rupees in thousand. 300. Write down 300 9 times. NPV, column number 5 minus 6. 5 minus 6. Try. 41.7. Without calculator also you can do it. 38. 117.7. 127.3. Without calculator. 207. 286.7. 396.3. 296.3. 376 and 455.7. Wait. Now the important task is joint probability. Joint probability means probability of getting 200 in year 1 and 100 in year 2. So that will be 0.3 into 0.3, 0.3 into 0.3, 0.09. Next 0.3 into 0.5, 0.15. Very important question. 0.3 into 0.2, 0.06. Don't miss it. You must practice it today. Next one, 0.4 into 0.3, 0.12, 0.4 into 0.5, 0.20, 0.4 into, what is that, 0.2, 0.08. Next, 0.3 into 0.3, 0.09, 0.3 into 0.4, 0.12. And the last one, 0.3 into 0.3, 0.09. Keep the notes in front of you. With the notes only you can understand. Now my job is almost done. You have to multiply these two columns and you have to use memory plus function also. Only in the first case it is negative, so use memory minus function. Learn to use calculator. Your exam is running short of time. Okay, race against the time in the exam. First one, negative, memory minus. Second one, all remaining memory plus. Multiply equal to memory plus. 5.7. Third one, very good, 7.062. Memory plus. Don't forget, memory plus function. Fourth one, 15.276. Fifth one, 41.4. Sixth one, come on here, write sixth one, 22.94. Now write here, 26.679. 9 right here, 45.12, and now write below 41.01. Just check and take the total of all these numbers from top to bottom and write here. Write the total here. Write the total here. 201.43. 201.43. Check the answer. 201.43. First question was, compute the mean of the probability distribution of the possible NPVs. The rate of discount is 12%. So this is my expected NPV. Mean NPV means expected NPV means average NPV. The second question is, second question from the book. Calculate the new mean NPV assuming company abandons the project if it is worthwhile to do so. That means the life of the project is 2 years. So the only abandonment possibility is whether you will abandon at the end of year 1 or not. And if you abandon, what will be the NPV? The abandonment value is 2,50,000. After year 1, you can terminate the project, get the scrap value 2,50,000. The question is, would you abandon? Would you abandon? If yes, under what circumstance? And what will be the new NPV? Okay, would you abandon the project? Step 2, evaluation of the proposal to abandon the project. Evaluation of the proposal to abandon the project. Evaluation of the proposal to abandon the project. So the question that we need to find out, should we abandon? Second question is, if yes, don't write, only understand. Under what circumstance? Under what circumstance we are going to abandon? And third question we have to answer, new mean NPV if we abandon. Okay, these questions I will answer tomorrow. In the meantime, you can try yourself. It will require a lot of thinking, and I need to give you time for thinking. So those who want the answer of the second part, on which you will get 5 to 6 mark, you will have to come tomorrow on time. Is it right? So see you tomorrow for the second part. In the meantime, as a homework, you can try part 2 of this question. Thank you very much. See you tomorrow. Bye bye.